Ed Yardeni is with us, President at Yardeni Research. James Knightley is Chief International Economist at ING. Gentlemen, great to have both of you here. Thank you for your time. Ed, how should markets sort of read what we've heard from President Trump on tariffs so far? Are we to make out that he's going to be pragmatic and it's going to be gradual in terms of tariffs and more of a negotiation rather than sort of putting it out there? Or
I think
you think it still could be the former? Go on.
Yeah, no, I think you're right. I think he's going to be pragmatic. He's going to be a negotiator. It's not going to be anything that startles or there's no shock and awe in his inauguration speech. He certainly talked about every issue that he's talked about before. So from that point of view, there's no real surprises. I think the market should just move on to the fundamentals that matter, and that's earnings. We're in a earnings season right now for the fourth quarter of 2024. We're actually raising our number. The market, the analysts are looking for a 9% increase on a year-over-year basis for fourth quarter earnings. We're looking now for 12%. We were thinking 10%, but the bank news was very, very strong. And so we think that earnings are going to carry the day here. That's what's going to drive the market higher from here on, not valuations, but earnings. And the companies that deliver better than expected earnings will be the ones that outperform. And there'll be a lot in the S&P 500, and there'll be a few in the mid-cap and small-cap area.
You think, Ed, there is, I mean, if it is going to be gradual on tariffs, sorry, just to stick with Trump for a bit longer, you think if it is that way, it's going to pan out that way, there is meaningful downside for the dollar, the broader dollar index?
I don't think so, because I think the Fed is on pause. I don't think they're going to be easing. I think one of the reasons the market did better last week is because Fed Governor Christopher Waller started talking about inflation being pretty close to where they want it to be, and that there might be several more rate cuts. But that just doesn't make sense to me. I think the economy is going to continue to be strong. I think inflation is going to remain sticky above 2%. So I think the Fed's done. If the Fed's done, then I think the dollar remains strong. And I think what we're continuing to see is a tremendous amount of inflows into our capital markets, into our stock market, and into our bond market. Bond yields are very attractive here relative to what's available overseas. So maybe you get a little better return in the UK, but you get more risk. So all in all, I think the dollar remains solid.
Okay. Got that, Mr. Yardeni. Let's bring in James Knightley as well from ING. James, hi. Do you broadly concur with that view? I mean, where do you see the dollar stabilizing? Of course, yesterday was a big pullback, relief reaction because there's no immediate tariff move. But what do you see ahead for both the US 10-year as well as the dollar?
Yeah, I certainly see the dollar remaining very strong, to be honest. We're seeing, again, a reaction this evening, US time, in terms of those comments, those headlines surrounding 25% tariffs on Mexico and Canada, leading to a bit of concern that that could yet see tariffs ratcheted higher as we progress through the year. There's still a lot of geopolitical uncertainty as well. And of course, you've got a situation whereby the Fed is not in a hurry to cut rates any further, whereas the ECB, the Bank of England, other central banks around the world very much are in rates cutting mode. We've got a situation whereby you've got no real political leadership in Europe right now. We've got German elections coming up in February. French elections aren't happening until the summer. So if you want any support from growth, it's going to have to come from the central banks. And that's that narrative, I think, again, points to more rate cuts coming through from there. And that should, again, help keep the dollar relatively supported.
All right. James, what are you factoring in now? But in terms of Fed rate action, I think the last time we chatted, you were hinting at 2 to 3. But going by the recent commentary and data points, are you trimming down that?
I think, like a lot of banks, we're still going for 2 or 3 rate cuts. I think still 3 rate cuts is our view, but certainly it's going to be later. We have been, for the last 6 months of last year, looking for a March rate cut. We're going to be pushing that probably back to June. So nothing really for the next 6 months or so. And indeed, we've got a Fed meeting next week, and it's likely to be one where the Fed is telling us, again, that they're in no hurry. The growth backdrop's pretty good, and Donald Trump's likely to cut taxes, light touch regulation as well, keep the growth story supportive, and in an environment where we're probably going to see more immigration controls, could be at the margin a little bit inflationary. Tariffs, again, could lift prices a little bit more. I think the Fed will be, again, signaling little inclination to cut rates quickly, but we are still nervous about ongoing rises in US Treasury yields, fiscal sustainability in a relatively high inflation environment.
Okay, all right, got that, James. Ed, coming across to you. You know, the last time we were chatting, we were, talking about maybe because the kind of gains that a lot of investors in the U.S. market are sitting on, we may not rule back some kind of a pullback. But earnings, as you said, have been fairly good, at least the start to the earnings. And it appears the U.S. economy as well is on a firm footing. In this sort of a backdrop, will you now rule out that possibility of maybe a 10, 15% cut in the equity markets in the United States? And now, in fact, maybe we could be ending the year with some gains?
Well, I think a week ago we did have a pullback on stronger than expected economic indicators. And so the market sort of dialed back how many rate cuts the Fed would deliver. And then last week we had softer than expected, cooler than expected inflation numbers. We also had better than expected bank data. And so the market was very strong. So right now, I think you can chalk it up to volatility. I don't know that we're making a definite trend to the upside to a breakout, but I do think that the market is likely to move higher over the rest of the year. Still using 7,000 as the S&P 500 by the end of the year. I think it could be none and done for the Fed because the more we get into the year, the closer we're going to get to rate cuts. To tax cuts, and then I can't see the Fed stimulating the economy when fiscal policy is doing that.
Just, James, very quickly, comment on this. Take your point, Mr. Yardeni. I mean, you're still thinking that the bulls will have their way on Wall Street. James, I know you're not into sort of managing money or don't call the markets, but generally the way you see all of this tying in together, do you see risk assets like U.S. equities continuing to appreciate, or is there anything on the horizon that makes you think that at some point there is going to be a pullback because the market perhaps is not reading entirely into the full macro signals?
I think in the near term, the risk environment is going to remain pretty positive. As Ed was saying, I think the earnings story for the fourth quarter should be very good, and that should carry momentum through the early part of the year. And again, light touch regulation, lower taxes, again, should be relatively supportive for that. Still a lot of uncertainty about how tariffs get implemented, but my concern is if the Treasury yields do keep marching higher. We've got mortgage rates up above 7%. We've got consumer credit charges up at 25+ year highs. If those do keep pushing higher in an environment of slightly higher inflation risks, some concerns about it, fiscal sustainability stories, that could be where there is a little bit of vulnerability, I would suggest.
All right. We'll leave it there for now. James, great conversation. Thank you very much. Ed, it's always a pleasure having you here on CNBC-TV18. We'll lean on both of you over the coming days to decipher if we are to hear more on tariffs or otherwise on other topics from President Trump. Well, we'll take a